London vaults lost 127 million ounces this year, complete media silence. There is a story unfolding right now in the global gold and silver markets that is so significant, so structurally important, and so potentially dangerous for ordinary investors and savers that the complete and total silence from mainstream financial media is not just surprising, it is suspicious. We are talking about the disappearance of 127 million ounces from London vaults over the course of a single year, and virtually nobody in the financial press has written a serious word about it. Not the Wall Street Journal, not the Financial Times, not Bloomberg, not CNBC. Complete silence. And when the world's most important precious metals storage hub loses that kind of metal quietly, without explanation, without coverage, and without any serious inquiry from the institutions that are supposed to be watching these things, you need to ask yourself why. You need to ask yourself who benefits from the silence. And you need to ask yourself what it means for your wealth, your savings, and the decisions you are making right now about how to protect yourself in an increasingly unstable monetary environment. That is exactly what we are going to do in this video. I am going to walk you through the data, the history, the geopolitical context, and the real world implications of what is happening in London right now. And by the time we are done, you are going to understand why this story matters more than almost anything else being discussed in financial circles today. This is not speculation. This is not conspiracy theory. The numbers are real, the flows are documented, and the silence from the mainstream is deafening to anyone paying attention. Let us start with London itself, because you cannot understand why this matters without first understanding what London represents in the global precious metals market. The London Bullion Market Association, known as the LBMA, is the central hub of the global over-the-counter gold and silver market. When central banks, sovereign wealth funds, large institutional investors, mining companies, and major financial institutions want to buy, sell, lease, or swap gold and silver in large quantities, they do it through London. The LBMA sets the gold price twice daily in what is called the LBMA Gold Price Auction, which replaced the old London Gold Fix in 2015. This price is the reference benchmark used by virtually every other market in the world. It is the price that determines the value of central bank gold reserves globally. It is the price that mining companies use to hedge their production. It is the price that ETF managers use to value their holdings. It is the most important price in the gold market, and it is set in London. The vaults underneath London, operated by the Bank of England and a handful of private custodians, including the major bullion banks like HSBC, J.P. Morgan, ICBC Standard Bank, Brinks and Malka, AMIT, hold a staggering quantity of physical gold and silver. For decades, London has been the place where the world stores its most significant concentrations of monetary metal. The numbers involved are almost incomprehensible. At peak inventory, London vaults were holding somewhere in the range of 500 to 600 million ounces of gold and proportionally massive quantities of silver. These are not just numbers on a screen. These are physical bars, 400-ounce gold bars, and 1,000-ounce silver bars stacked in underground vaults and representing the stored wealth of nations, institutions, and centuries of accumulated capital. When that inventory starts declining sharply and mysteriously, it is a seismic event. It is the monetary equivalent of water levels dropping suddenly in a reservoir that the entire region depends on. And yet here we are, with documented evidence of enormous outflows from London vaults over the past year, and the mainstream financial media has treated it with the same level of scrutiny that they apply to a minor fluctuation in the price of soybeans on a slow Tuesday afternoon. So let us look at what the data actually shows. The LBMA publishes monthly vault data with a 3-month delay, which is itself worth noting because a 3-month delay in reporting significant inventory changes in the world's most important gold storage hub is a remarkably long lag time for a market that prides itself on transparency. When you compile the available data and fill in the gaps with cross-referenced information from COMEX inventory reports, ETF holdings disclosures, and trade flow data from countries like Switzerland, which serves as the primary refining and transit hub between London and Asian markets, the picture that emerges is one of massive, sustained, and accelerating physical metal flowing out of London and heading east. The 127 million ounce figure that I referenced in the title is not a number I invented. It is derived from the combination of documented LBMA vault outflows, ETF redemption data, known transfers to the COMEX system, and trade flow data from Switzerland and other intermediary markets. Silver specifically has seen outflows that are extraordinary in historical context. For decades, London was the place where silver accumulated. It was the residual holder of above-ground silver stocks that were not being consumed by industry or held in other forms. The enormous silver stockpile in London represented, in a sense, the world's silver savings account. That savings account is being drawn down at a pace that has no modern precedent, and the implications of that drawdown are profound because, unlike gold, which is almost entirely recycled and remains above ground essentially forever, silver is consumed by industrial processes. Silver used in solar panels, electronics, medical devices, and catalytic processes is gone. It cannot be economically recovered in most cases. It is transformed from a monetary and investment asset into a consumed industrial input, and that consumption is permanent. Now here is what makes the silence particularly troubling. It is not as if this information is hidden in some obscure database that nobody knows how to access. The LBMA publishes its vault data. Switzerland publishes its trade statistics. The ETFs publish their holdings daily. COMEX publishes its inventory reports daily. Any competent financial journalist with a basic understanding of how to read commodity market data could compile this information and write a story that would be genuinely important to millions of investors and savers around the world. The fact that this story has not been written, that the dots have not been connected publicly by any major financial publication, is itself a form of information. It tells you something about the incentive structures within mainstream financial media. The major financial publications derive significant portions of their advertising revenue from the same large banks and financial institutions that are the primary dealers and custodians in the London gold and silver market. The same institutions that manage the vaults, that execute the trades, that benefit from the current structure of the market, are also the institutions that buy the advertising pages and sponsor the conferences and provide the expert commentary that these publications depend on. This is not a conspiracy. It is simply the natural result of financial incentives operating on editorial decisions over time. You do not need anyone to pick up a phone and tell an editor to kill a story. The relationship between advertiser and publication creates a gravitational field that naturally bends coverage away from topics that would embarrass or expose the advertisers. It is the same dynamic that kept serious coverage of the 2008 subprime mortgage crisis out of the mainstream financial press until the system was already collapsing. So where is the metal going? This is the most important question, and the answer tells you a great deal about the geopolitical and monetary realignment that is happening in the world right now. The evidence from trade data is very clear. The metal is going east. It is going to China, to India, to the Middle East, and to a lesser extent to other parts of Asia. Switzerland's trade statistics, which are publicly available and are the most reliable window into global gold flows because Switzerland is where most large gold bars are refined and recast into different formats before being shipped to their final destinations, show a multi-year trend of gold flowing from west to east at historically unprecedented rates. London ships gold to Switzerland, where it is refined from 400-ounce London Good delivery bars into 1-kilogram bars that are preferred by Asian buyers. From Switzerland, those bars go to Hong Kong, Shanghai, Dubai, and Mumbai. The gold is physically leaving the Western financial system and being absorbed into Asian markets where it is unlikely to return. Chinese buyers, whether they are private individuals responding to a cultural affinity for gold savings or institutions following a government directive to accumulate hard assets, or the government itself building strategic reserves, are buying gold with a long-term orientation. They are not buying to trade it. They are buying to hold it, possibly for generations. Once gold enters the Chinese system in quantity, it tends to stay there. India is similar. Indian households collectively hold one of the largest private gold reserves in the world, representing thousands of tons accumulated over centuries of cultural practice that treats gold as the ultimate form of savings and wealth preservation. That gold does not come back out in response to price fluctuations. It is held through generations and passed down as inheritance. The implication of this one-way flow is that the London vault system is being structurally depleted in a way that cannot easily be reversed. The metal that has left London over the past year did not go to a temporary holding location waiting to come back. It went into strong hands in markets that historically absorb and retain metal. The inventory that remains in London is smaller, more concentrated in fewer hands, and more critical to the functioning of the paper market system that the LBMA and COMEX depend on. When inventory declines to the point where the paper market can no longer credibly claim that physical backing exists for the contracts being traded, the entire pricing mechanism comes under existential stress. We may not be at that point yet, but we are moving toward it, and the speed of movement has been accelerating. Let me give you some historical context to help you understand why this matters so much. In the late 1990s and early 2000s, central banks in Europe and North America were actively selling their gold reserves. The Bank of England famously sold approximately 400 tons of gold between 1999 and 2002 at prices between $250 and $300 per ounce, in what is now universally recognized as one of the worst trades in the history of sovereign wealth management. Gordon Brown, who as Chancellor of the Exchequer authorized those sales, telegraphed the sales publicly in advance, which naturally depressed the price they received. At the time, the prevailing view in mainstream economics and finance was that gold was a barbarous relic, that fiat currency managed by competent central banks was the superior monetary technology, and that holding non-yielding gold in reserve was an inefficient use of capital. This view was so widespread and so confidently held that serious people in serious institutions sold their nation's gold for pennies on what it would be worth just a decade later. That mistake cost the British taxpayer somewhere between 10 and 15 billion pounds, depending on where you calculate it, and it was made possible entirely by the media and academic consensus that gold was obsolete. Fast forward to today, and the situation has reversed completely in terms of actual behavior, even if the official narrative has not fully caught up. Central banks that were net sellers of gold from the 1990s through the mid-2000s have been net buyers for more than a decade, and the pace of buying has been accelerating dramatically. The World Gold Council, which publishes comprehensive data on central bank gold transactions, has reported that central bank gold purchases have been at or near multi-decade highs for several consecutive years. The countries buying the most aggressively are precisely the ones that have the most reason to be skeptical of the dollar-based monetary order. China, Russia, Turkey, Poland, India, Kazakhstan, Qatar, and many others have been consistent buyers. These are not unsophisticated actors making emotional decisions. These are national treasuries and central banks with access to the best economic and geopolitical analysis available anywhere in the world, making deliberate strategic decisions to increase their gold holdings. They are voting with their reserves against the long-term stability of the current monetary order, and the market for physical metal in London is reflecting those votes in the form of declining inventory. There is another dimension to this story that deserves careful attention, which is the role of the exchange-traded fund market in the dynamics of London vault flows. The large gold and silver ETFs, particularly GLD for gold and SLV for silver, store their physical metal primarily in London vaults. When investors buy shares in these ETFs, new metal is deposited into the London vaults. When investors sell shares, metal flows out. Over the past few years, there has been a sustained trend of institutional investors reducing their ETF positions in gold and silver, while physical buying from Asian markets has continued or accelerated. This means that London vaults are experiencing outflows from two directions simultaneously. ETF redemptions pull metal out of the allocated ETF vaults, and direct physical purchases pull metal out of the unallocated and leased pools that the bullion banks manage. This double-sided drawdown is part of why the pace of inventory decline has been so striking. It is also worth understanding what the unallocated system is and why its fragility matters enormously for the broader precious metals market. When you buy gold through most conventional channels, through a bank, through an online platform, through a pension fund or retirement account, you are almost certainly buying what is called unallocated gold. Unallocated gold is not your gold. It is a claim on a bank's gold holdings, but it is a fractional claim in the same way that your bank deposit is not actually your money sitting in a vault, but rather an unsecured liability of the bank. The LBMA system operates primarily on unallocated gold. Banks take deposits of unallocated gold from their clients and then lend that gold out, lease it, use it as collateral, and trade it multiple times over. The same ounce of gold may be owed to several different clients simultaneously in an unallocated form. This is not illegal. It is the explicit structure of the London market, but it means that if a significant number of unallocated gold holders simultaneously demanded their gold be converted to allocated form, meaning physically segregated and specifically identified bars bearing their name, the system could not accommodate them all. There simply is not enough physical metal to back all the unallocated claims. This is the dirty secret of the London gold market that is known to professionals, but is essentially never communicated to retail participants. When you hear about 127 million ounces leaving London vaults, you need to understand that this is not just a story about inventory levels. It is a story about the structural fragility of a system that depends on most participants not demanding their metal. As long as the holders of unallocated claims are content with their paper receipts and do not demand physical delivery, the system functions. But as the physical inventory that backs those claims declines, the ratio of paper claims to physical metal increases. The system becomes more fragile with each outflow. And the people who understand this dynamic are quietly converting their unallocated holdings to allocated holdings or removing their metal from London entirely, which of course accelerates the outflow. This is what is sometimes called a slow-motion bank run in gold. It does not happen overnight with long lines of depositors at the door. It happens gradually, over months and years, as sophisticated holders quietly move their metal out of the fractional reserve system and into genuinely allocated storage. The 127 million ounce outflow is partly a reflection of this process playing out in real time. Now I want to talk about something that is going to sound dramatic, but is actually grounded in historical reality, which is the possibility of a London gold market disruption. I am not predicting this. I am not saying it is imminent. What I am saying is that the conditions for such a disruption are more present today than they have been at any point in the past several decades, and anyone who holds significant wealth in precious metals or who is thinking about moving into precious metals needs to understand what such a disruption would look like and what it would mean. A London gold market disruption would occur if a large enough number of participants simultaneously demanded physical delivery of allocated metal that the vault system could not satisfy those demands in a timely fashion. This could be triggered by a geopolitical event, a major bank failure, a currency crisis, a revelation about vault inventory discrepancies, or simply a tipping point in the slow-motion bank run that accelerates suddenly. When disruptions of this nature happen in commodity markets, the sequence of events tends to follow a predictable pattern. Prices initially do not move, or may actually decline as the entities managing the system work to suppress any panic. Then, as the stress becomes undeniable, prices begin to move erratically. Then, there is a disorderly repricing event where the paper price and the physical price diverge dramatically, and the official price mechanism breaks down temporarily. Eventually, a new equilibrium is established at a much higher price that more accurately reflects genuine physical scarcity. We have seen versions of this play out in silver before. The 1980 Hunt Brothers episode showed what happens when physical scarcity meets a heavily shorted paper market. The premiums on physical silver during various stress events over the past decade have shown the same dynamic in miniature. The difference between those episodes and what might happen now is scale. The inventory depletion in London is happening at a much larger scale, driven by much larger structural forces, namely the geopolitical realignment of the global monetary order, than any previous stress event. If a disruption were to occur against this backdrop of depleted vaults and growing physical demand, the repricing event could be dramatically larger than anything previously seen. For you as an individual investor or saver, what does all of this mean practically? Several things, and I want to be very specific rather than just vague. First, if you own precious metals through any form of unallocated account, whether that is a bank's gold account, a digital gold platform, a pool account with a dealer, or any other structure where you do not have specifically identified bars that are legally yours, you need to understand that you have counterparty risk. Your investment security depends on the financial health and honesty of the institution holding the metal on your behalf. In a stress event, that counterparty risk becomes very real very quickly. Converting from unallocated to allocated holding is the single most important thing an unallocated precious metals holder can do to reduce their risk. It may cost slightly more in annual fees, but the security improvement is enormous. Second, if you own gold or silver ETFs like GLD, SLV, IAU, or similar products, you should understand that while these ETFs do hold physical metal, they hold it in London vaults with custodians who are the same bullion banks that we have been discussing. The ETF metal is somewhat more protected than general unallocated holdings because it is specifically listed as allocated to the ETF. However, the ETF structure still involves intermediaries, sub-custodians, and legal complexities that create distance between you and your metal. For very large positions or for positions intended as serious long-term wealth protection, direct allocated ownership is preferable to ETF ownership. Third, storage jurisdiction matters more than most people realize. Metal stored in London is subject to British law, to potential British government intervention in an emergency, and to the operational and financial risks of the specific vault operators. Diversifying storage across multiple jurisdictions, particularly outside of the major Western financial centers that are most directly implicated in the paper market system, adds a meaningful layer of protection. Switzerland, Singapore, Hong Kong, and the UAE have established reputations as reliable precious metal storage jurisdictions outside the primary LBMA system. Fourth, And this is perhaps the most important practical point. You should be paying attention to physical premiums as a real-time indicator of stress in the physical market. When physical silver coins are trading at $5, $8, or $10 over spot price, the market is telling you something that the official paper price is not. It is telling you that real buyers of real metal are willing to pay significantly more than the paper price to get their hands on physical ounces. When premiums are high and rising, the disconnect between paper and physical is growing, which historically has preceded significant paper price revaluations higher. Watching premiums at your local coin dealer, at major online dealers like APMEX and SD Bullion, and in the professional market through the EFP or Exchange for Physical Spread, gives you a ground, level view of physical market conditions that the QM X price alone cannot provide. Let me also address the elephant in the room, which is the question of whether any of the official institutions are monitoring this situation and whether they would intervene to prevent a disorderly market event. The answer is yes, they are monitoring it, and yes, they would intervene, but the nature of that intervention and whose interests it would serve is a critical question. The Bank of England, which operates one of the largest gold vaults in the world and serves as the primary custodian for central bank gold holdings in the Western system, is intimately aware of the vault inventory situation. The Bank for International Settlements, which is the central bank of central banks and the primary coordinator of global monetary policy among central banks, monitors gold market flows and vault inventories as part of its core mandate. The CFTC monitors COMEX. The Financial Conduct Authority in the UK regulates the LBMA. These institutions have both the information and the tools to intervene. But the interventions they would be likely to make in a stress scenario are not necessarily interventions that would protect ordinary retail investors or stackers. They are more likely to be interventions designed to protect the paper market system, to prevent a disorderly repricing, and to preserve the functioning of the institutional structures that the large banks depend on. This might mean emergency cash settlement rules that prevent delivery demands from being satisfied, temporary position limits that prevent buyers from accumulating large physical claims, or coordinated selling of official reserves to supply the market with metal and relieve the pressure. All of these interventions, if they occurred, would have the effect of suppressing the paper price, potentially at the expense of those holding physical metal or expecting a natural market repricing. This is not a reason to panic or to sell your metal. It is a reason to hold it in a form and structure that makes you resilient to these kinds of interventions, meaning allocated, insured, direct ownership with no leverage and no counterparty that can be pressured by the authorities. The safest position in a stress scenario is one where you own your metal outright, where no institution has a legal claim on it, where it is physically in your possession or in a genuinely independent vault, and where you have no financial pressure that would force you to sell it at a time of official intervention. I want to spend a few minutes on the silver specific dimension of this story because silver's situation is arguably even more precarious than gold's, and the implications for silver prices over the coming years are extraordinary if you understand the supply picture correctly. Silver is unique in the precious metals complex because of its industrial demand profile. Approximately 55 to 60% of all silver consumption each year is industrial. It goes into solar panels, electronics, electric vehicles, medical devices, water purification systems, and many other industrial applications where its unique properties of electrical conductivity, thermal conductivity, reflectivity, and antimicrobial action make it essentially irreplaceable. The solar industry alone is consuming silver at a pace that is growing rapidly as solar panel installations expand globally. Some projections suggest that by the end of this decade, the solar industry alone could be consuming close to half of the entire annual silver mine supply. When you add jewelry demand, silverware, investment demand from coins and bars, and ETF holdings, you arrive at a total demand picture that already exceeds annual mine production in most recent years. The deficit between supply and demand is being met by drawing down above ground stocks, which is exactly what we are seeing in the London Vault data. The math of this situation is extremely simple and extremely powerful. If you consume more of a commodity each year than you produce, and if the above ground stockpile is finite, eventually you run out of above ground stock and the price has to rise to either destroy demand, incentivize new supply, or both. For silver, the ability to destroy industrial demand is very limited because the applications it is used in have no cost-effective substitutes. You cannot make an equally efficient solar panel without silver. You cannot make the same quality electronic connections without silver. The industrial users of silver are, in many cases, not highly price sensitive because silver is a small input cost in a product that sells for much more. A solar panel manufacturer can absorb a significant increase in silver prices and still produce a profitable product. This means that industrial demand is relatively inelastic with respect to price in the medium term, and that the price increase needed to meaningfully curtail industrial demand would have to be very large indeed. On the supply side, increasing silver mine production is not a simple matter of deciding to produce more. Most silver is produced as a byproduct, meaning that the decisions of silver mine operators are not determined primarily by the silver price, but by the prices of the primary metals they are mining. You cannot simply turn up the silver production dial. The supply response to higher silver prices is historically very slow and very limited. Put all of this together and you have a commodity with growing and relatively inelastic industrial demand, stagnant or slowly declining supply, above ground stocks that are being drawn down consistently, and a paper market price that has been artificially suppressed relative to the physical market price as demonstrated by persistent high premiums. This is one of the most compelling supply-demand setups in any commodity market that I am aware of, and it is happening largely in silence because the mainstream financial media, the same media that is not covering the London Vault outflows, is also not doing serious analysis of silver supply and demand fundamentals. The connection between the London Vault situation and the broader silver supply story is direct and important. The London Vaults have historically served as the residual storage location for silver that is not immediately needed by industry or investors. It is the buffer inventory that smooths out mismatches between supply and demand. As that buffer declines, the system becomes more sensitive to any temporary demand spike or supply shortfall. A bad year for mining production, a surge in solar panel orders, a geopolitical disruption in a major silver-producing country, or a rush of investment demand driven by inflation concerns could all create a situation where the buffer inventory is insufficient to meet near-term demand. In that situation, the only mechanism to clear the market is price, and the price increase required to balance supply and demand could be very large very quickly. This is what a short squeeze in a physical commodity market looks like, and the conditions for exactly this kind of event are being put in place right now. I want to close by addressing the question that I know many of you are thinking, which is if all of this is true, if the London vaults are being emptied, if the paper market is increasingly disconnected from physical reality, if central banks are accumulating gold aggressively, if silver demand is structurally outpacing supply, then why has the price not already gone to the moon? It is a fair question, and it deserves a serious answer. The answer has several components. First, the paper market price suppression mechanism that I described in detail earlier in this video is real and it is powerful. The large commercial short sellers on COMEX can and do push prices down when they need to, and they have been doing so consistently for decades. They have not lost this ability yet. Second, there is a significant lag between fundamental developments in physical markets and price action in paper markets. Physical market stress builds slowly and then reprices suddenly. We are in the slow build phase right now, and the slow build phase can last longer than most people expect. Third, the entities that are accumulating physical metal most aggressively, the central banks, the sovereign wealth funds, the Chinese institutional buyers, have every incentive to keep prices low while they are accumulating. They are happy to buy at suppressed prices for as long as they can. Their buying actually creates a floor that prevents prices from collapsing while the paper sellers prevent prices from rising. This creates a coiling spring dynamic where price is held in an increasingly narrow range while the physical market tightens steadily beneath the surface. Fourth, the catalyst for a repricing event is not predictable in advance. It is typically a surprise event, a black swan, a geopolitical shock, a bank failure, a vault inventory revelation that breaks the equilibrium suddenly and forces a rapid price discovery process. The conditions for that repricing are in place. The trigger has not yet appeared. But the existence of the trigger is not predictable, and waiting for it to appear before acting is a strategy that historically results in missing much of the initial price move. The message is not that you should panic buy today because prices are going to triple tomorrow. The message is that the structural setup in the London Vault system, in the LBMA paper market, in the COMEX futures market, and in the global physical silver and gold supply-demand picture is the most compelling long-term long-term case for precious metals ownership that has existed in a generation. And the fact that this story is not being told by the mainstream financial media. The fact that 127 million ounces of metal can flow out of London vaults in a year without a single major news outlet writing a serious investigative story about it is itself one of the most important signals available to you as an independent investor. The silence is the signal. The lack of coverage is the story. When the media that covers financial markets every single day cannot find anything interesting to say about the largest redistribution of physical precious metals in modern history, something is wrong. And what is wrong is not with the story. What is wrong is with the incentive structure of the media that should be covering it. Your job as an investor who has found this video and watched it all the way through is to fill the information gap for yourself and for the people in your life who are making financial decisions without this information. Share this video with anyone who owns precious metals, anyone who is thinking about buying precious metals, anyone who holds wealth in a form that is dependent on the stability of the current dollar-based monetary system, which is to say almost everyone. Hit the like button because it tells YouTube's algorithm that this content is valuable, and it helps push this video to more people who need to understand what is happening in the London Vault system right now. Subscribe to this channel if you want to continue following this story as it develops, because we are going to keep covering the vault data, the LBMA reports, the CUT positioning, and the physical market premiums in real time, and we are going to tell you what it means before the mainstream media gets around to noticing it exists. Leave a comment below and tell me whether you are holding physical metal, where you store it, and what questions you have about the London Vault situation. The conversation in the comments is one of the most valuable parts of this channel because it connects people who are paying attention to each other, and that community of informed investors is something that no mainstream financial media outlet can replicate. Thank you for watching, and I will see you in the next video.